Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I hope everyone enjoyed the lighthearted video of my bike trip last time, but now we're back to the hardcore financial topics in investing. Today, we'll be looking at whether you should and can time the market. The short answer is it is impossible to time the market to buy at the bottom of the valleys and sell at the tops that happen along the way as the market grinds its way up. So don't even try. You have to be right twice, when to get out and then when to get back in. All the experts that think that they know where the peaks and the valleys are don't know either. At best, they have an opinion, and they are going to be wrong quite often. Retail traders, people like you and I, underperform the index because they buy at the top since they're afraid of missing out on something that's been going on for a long time and it's just kept going up and up. And they also sell at the bottom because they are afraid it's going to go to zero. They will panic, they're emotional, whether they're scared, overconfident in their own knowledge, or greedy. One statistic I found was that for the 20 years ending at the end of 2015, the S&P 500 index averaged 9.85% a year. The average equity fund investor earned a market return of 5.19%, underperforming the index by a significant amount. And this is because they did the wrong thing at the wrong time, mostly because of emotions. So just to expand on this, let's discuss what you should do when markets go down. There's 3 things that you can do. You can sell, you can do nothing, or you can buy more. So if you decide to sell, that's generally the worst thing that you can do because the market's already dropped by the time you sell. So you might be selling near the bottom. It also throws your portfolio into disarray since you can't plan and do it in an orderly fashion. You could do nothing, which is the course of action advocated by most financial advisors. The market's going to come back, and the financial advisor doesn't have to fill out any paperwork. The best thing you can do is buy more. When prices are low, and they will go back up, the stocks are on sale, so why not buy more? However, this is easy to say and hard to do when you're looking at a big pull back in the stock market. I would suggest just to keep investing in the same investments as soon as you make the money using dollar cost averaging month after month into good mutual funds or choose index mutual funds or index ETFs. If you feel the need to try to outperform the market, do it with a small percentage of your portfolio and use the mad money. I want to outline my strategy for the stock market for you, just so you know how I look at things with my own money, of course. Now, I put this strategy together because I was texting a friend of mine who was beginning to frustrate me a little bit because he kept on trying to find and was asking me to help him find the very bottom of a market back in the March of 2020. He wanted to buy a stock, but as the stock kept going down, he avoided buying it because he was trying to buy it at the very bottom. And then when it started going back up, he said, well, I guess I missed it. And the stock was still down about 30% from the peak, but that wasn't good enough. He wanted the very bottom, and that's just not something that we can do. So here's my strategy. And it sounds more like a mission statement, but number one, I realize I am unable to time the market even reasonably, let alone perfectly. I will not be able to find a bottom to buy nor a top to sell. Number two, I stay invested at all times, putting spare cash into the market because the market goes up in the long run. So in 5 years, I will still be up. I also keep a small amount of cash as an emergency fund, however. And number three, if there's a drop of more than 20% in the overall market, I buy more using my home equity line of credit as an extraordinary purchase because the market is on sale. It could go down some more, but it's impossible to know where the bottom is, so I'm satisfied with a 20% discount, and I will be happy when the market comes back up. You'll notice there's nothing about selling in my strategy. The market peaks make me feel good, but if I were to sell, I'd have to find other investments that were at their bottom to put my money into. And I'd have to be right twice, as I mentioned. Plus, I am still in my accumulation phase. So as long as I think the investment is good, I keep adding to it. If I think the investment is not good anymore, I will sell and I will buy something that I believe will go further up. Some people will liquidate their whole portfolio on a hunch. A work friend went to gold before the 2016 election and the market went up instead. And so he felt silly. He thought the market would go down, but of course, after the US 2016 election and Trump being in power, the market went up. But he didn't really learn and continued to try to fiddle with his portfolio based on intuition and various experts. I don't think it really worked out for him. I, for one, don't want to ruin my whole portfolio set up on a whim. The market could be doing a head fake, and to get out after it goes down 10%, for example, it could go right back up again. So I could have sold everything and 1% more down, and then it started going back up. So if I do get out, also I need to know when to get back in, and nobody knows that. So I just stay invested. And of course, the experts say the old cliche, it's not timing the market, it's the time in the market. Going back to my own personal theory and the way I like to do things, the only question I have when investing is whether to keep cash on hand, which is making 1% in an online bank, or whether I should use the HELOC, which doesn't cost me anything when I'm not using it. But then when I am borrowing to invest, it adds risk. So I've chose to use the home equity line of credit because I have dividends to cover the interest, and I buy dividend stocks with the borrowed money anyway. So that should cover the HELOC interest. The whole thing is also tax friendly since my Canadian dividends pay Canadian eligible dividends, which are not really taxed. And I get to write off the interest on a home equity line of credit at the full tax rate. To conclude, don't try to time the market. It's futile. Even the experts don't get it right most of the time. So you are going to be right about 50% of the time. Have more income than expenses, invest the difference regularly, and you'll end up looking great over time. So if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.